Hi students, welcome back. In this segment, we are going to be talking about a particular type of economic flow which has become quite heightened in the contemporary version of globalization, and it is also one of its most debated aspects as well. I am, of course, talking about financial globalization. Now, you may ask, what is financial globalization and how does it differ from what existed earlier? By financial globalization, we refer to the movement of course, as the term suggests, finances, but this is not the same as simply, let's say I decide to kind of, go somewhere to look for a job, or I move somewhere to set up, move to a different country to set up my own production plant, etc. By financial globalization, we are referring to activities in the financial realm. Particularly, something that attracts our attention is, the speculative nature of these financial flows, and it's certainly something that involves very fast movement of money and currency. This happens in various currencies. Okay. The other aspect of this is that these economic flows are, so for instance, I don't know if you've ever seen how the Nifty or the Sensex works. Okay. These are kind of, indicators of financial markets, and their value can drop and fall at the snap of a finger, right? So we are really talking about these very instantaneous transactions in the realm of finance that are taking place. And today we are living in a world where this kind of a, financial flow is not something that happens only in one market, okay, or in sort of the financial market of one country, but it links together many different financial sort of official markets of various countries. So which means that a movement that happens in one place has a sort of cascading effect in multiple markets around the world. Perhaps, and you will forgive me for bringing up multiple crises, but in some ways the crises in financial markets are illustrative, because I think they help us see clearly just how interconnected these markets are. Okay, let's take the example of the global recession that happened in the year 2008. So it's very interesting, and of course there's also a very interesting film made on this called The Big Short. If you have the time, you should definitely watch it. But what happened as part of this financial crisis was that the US economy really is built on its housing market. So basically, supposing I want to buy a house, I will approach a bank for a loan. The loan, the bank is going to grade me for, my capacity to actually pay back that loan. If I look like a person who is going to be able to pay back the loan soon without any glitches, maybe I'll get an A-star rating. Someone else is going to, looks like a shady character, can't pay back the loan, may even default on the loan, maybe they get a D rating. Now, so I think we are all aware of how this loan system works with banks, right? Now, what has happened over time is that there have been very complex financial instruments that have been created. And in the context of the financial crisis of 2008, what happened was that different types of loans, housing loans, were clubbed together and then sold to buyers. Okay, so if you will probably need a finance person to explain this to us, how this clubbing happened. And in fact it was such a complex process that even the regulators of financial markets in the United States could not fully decipher how these instruments were created, what were the implications, what should be the valuation, so on and so forth. Okay. Now, what happened was that these loans, these combinations of loans, these financial instruments, were sold to parties around the world, and one set of buyers were the banks of Iceland. Okay. Now, of course, perhaps there were too many defaults. It could have been some other kind of systemic shock, but the housing market in the US collapsed. And in fact, because the Iceland banks had sunk in so much money into these financial instruments, it led to a collapse of the banks in Iceland as well. Okay, the other impact that happened, so that was a shock because it created waves in the EU and the European Union and also other European countries. Okay, the other aspect of this was that the American economy, because it's still a very significant player which engages in a lot of trade and financial transactions with many other countries in the world, because it received such a huge systemic shock, it sent ripples across. I wouldn't call them ripples; they were waves of depressed economic activity across various national economies in the world at that time. Okay, so this is, I think, just to show you just how interconnected these different markets can be. These markets can be very, very far away from each other, but through transactions which are particularly instantaneous in nature, it can actually lead to sometimes, of course, there's also euphoria, right? If the market is looking up, then that mood may also travel to other markets. Another example that I can think of was the collapse of the East Asian economies in the mid 90s. Now, if you recollect, in the last chapter, we had taken a look at different kinds of transnational corporations, right? So we spoke about FIIs, FDIs, and greenfield investments. Now you will see, and it has been actually a policy of the Indian government, that typically there is more of an emphasis. This policy has been around for many decades. Okay, that typically it was a FDI, okay, foreign direct investment, that was much more encouraged than FIIs, foreign institutional investors. And in some ways that proved to be a wise choice when we look at the East Asian crisis of 1997. So one of the reasons why there is such a hesitation towards the entry of foreign institutional investors is that because foreign institutional investors do not have significant ownership or significant control. It's primarily financial money which is moving from one economy to the next. Sometimes, this financial money may not even be hard cash. Very often it's not hard cash. It's built off of some speculations. I anticipate that the share rates are going to go up or down, and therefore I will create this much profit. So based on that expectation, now I'm going to engage in a trade. Okay, so because of this, what happens is that when there is even the slightest shock, it can lead to a panic exit of the FIIs, which is what happened in the 1990s in the East Asian economies. I'm talking about Hong Kong, Taiwan, I think maybe Indonesia as well, Malaysia, these kind of economies. So interestingly enough, even there was a housing market, the bubble burst over there. But of course, these are just, it just so happens that the two examples we took involved a housing market crash. But basically what had been happening was that, the valuation of housing in those countries had been rising higher and higher, and, in some ways it was inflated. And because of that, a lot of foreign institutional investors were, because it was easy for them to gain entry into these markets, they were flocking and everyone was parking their funds in these economies. When the housing market crashed there, it generated a panic exit of all these financial, of the FIIs, foreign institutional investors, and that led to a huge collapse of these interconnected economies at that point. So again, apologies if we're talking about really depressing things like crises moments, but it is, I think, in these crises moments that it becomes very clear how the markets of different countries are linked together by these kind of fast moving financial flows.